the key is for the Fed to be offering this payment backbone to fintech. You need to be getting a bank in particular, but maybe other firms too, have to be getting a certain fraction of their funds from stockholders. If it's stockholders taking the risk rather than folks buying bonds who think that it's safe when it really isn't, then you get less trouble. I wish economists had a bigger role in pandemic policy, because supply side policy is much more than what a lot of Republicans have called it, which is tax cuts are the only supply side policy. Taking risk is good in a recession. That's why you need negative interest rates.
Following is a conversation with Professor Miles Kimball, who is a professor of economics at the University of Colorado Boulder. He's also the author of the popular economics blog called The Supply Side Liberal. In this conversation, we dive deep into creating monetary policies, digital currencies, how should fintechs look at building on top of digital currencies, challenges and opportunities for fintechs, zero inflation rates, negative interest rates, the economics of food, nutrition, the challenges in overcoming social problems like poverty, malnutrition, etc., and how do you address these from an economics as well as an institutional perspective in terms of implementing mass-scale changes. This conversation is fairly long. It's close to 2.5 hours. So maybe grab your favorite snacks or drinks, maybe your favorite person, and sit down and enjoy this conversation, spanning big money to global recession, to the economics of well-being, to the economics of taking risks and building businesses, and much more. On Curiously with KVK, here we have the conversation with Professor Miles Kimball. Hi, Professor Kimball. Thanks a lot for taking time today to have this conversation with me. So, how are you doing today? How is it early morning in the Eastern Coast?
Yeah, it's on the East Coast. I am here in Ohio, but this is nice.
Wonderful. So I've
got the sun shining.
The first time I probably came across you and some of your work was, and I think I was reading this 2017 essay that you had written on what should be the ideal monetary policy. But while I might have a lot of questions around monetary policy and then zero lower bounds and going beyond zero lower bounds and stuff like that, I think the first question I would want to ask is when and how did you conceive this idea of being a supply side liberal?
Oh, well, in 2012, when I started my blog, I'm trying to think if I had thought about that before, but no, I think it was something I figured out when I was starting my blog. I started to dream of names for the blog, but I've always delighted in not being able to go into the regular pigeonhole. So I've always liked the idea of being something different.
So, of course, I've gone through your website and stuff, but do you want to maybe throw light on what you think is being a supply side liberal and why do you identify so strongly with it?
Well, nowadays, just the subtitle of the blog is also relevant, a partisan, nonpartisan blog. So that means I have strong opinions and I argue for them, but they don't line up neatly with the political parties. And so I've been, I'm a political independent. I do vote in primaries because I've been in many states with open primaries, but and choose whichever primary is most interesting. But that kind of political independence is a big part of it. And I see that as a kind of issue by issue approach to things. For example, Donald Trump is somebody who's in favor of negative interest rates. That doesn't make me think worse of negative interest rates just because Donald Trump likes it. So, of course, I was there first, long before the Donald got into talking about negative interest rates. Right. But I didn't suddenly and oh no, Donald Trump likes negative interest rates. I can't be for negative interest rates anymore.
Right. So when we speak of this idea of negative interest rates, we're basically telling that, the borrower is supposed to be receiving more money to be borrowing more. And, if you look at the essay written by Iglesias that talks about how, let's say maybe money or the physical cash is probably, one thing that was potentially hindering the idea of ending recession. But clearly we realize a decade later that it's probably not.
Well, let me say, I've got to say something first because of the moment that we're in. As if you look at my Twitter feed, I've been really busy lately, so I haven't been tweeting as much. But a large fraction of my tweets are saying we should be raising rates faster. So it's not like negative interest rates are appropriate to every moment. Here we have rising inflation, and my co-author Ruchira Agarwal and I have said we might well need 7% interest rates, and that's just saying you probably need a couple of percent above inflation. So this is not saying some strange thing, but it is beyond the conventional wisdom. But they're actually connected to negative rate policy, because one of the big reasons that the Federal Reserve has been so timid in raising rates is because they were afraid that if they got into a big recession, they couldn't get out of it. But if you have negative interest rates in the toolkit, then you can raise rates fast. You can raise rates a long way to cut inflation off in its tracks. And if you go too far, you just reverse course. And so you could go up to 7% immediately. And if you got into a big recession by mistake, I'm not, obviously the details matter and you do the best job you can. But if you did make a big mistake, then you can go to minus 7%. And so the theme is really, and I'm probably exaggerating what would actually be needed, but the theme is you move interest rates a lot to make recessions go away fast, to nip inflation in the bud. We could have much better monetary policy, but it's not about negative interest rates all the time by any means. It's about moving interest rates a lot to keep the economy on an even course.
Got it. But maybe I would like to take a step back, and maybe this is just me being naive here. But when we speak of, let's say, introducing negative interest rates, we typically speak in the context of deflation, right? Whenever there's deflation, we sort of look at negative interest rates as a means to sort of incentivize people to take that risk, go ahead and do some activity that's potentially going to, earn more for themselves and consequently increase spending. And then maybe, the economic cycle goes on and on and on. But then the question that I want to ask there is how would it be, let's say, significantly different from just printing money and distributing to people?
Oh, well, having what matters most for economic stimulus is the real interest rate, and so that's how high the interest rate is relative to inflation, and so that's what that was relevant a minute ago when I said you got to have a real interest rate above zero, or an interest rate a little bit above inflation, or you can't restrain the economy. But if you need more stimulus and you need an interest rate below inflation, there are two ways to get that. One is by having high inflation and having the interest rate at zero, let's say, or it's having no inflation and having the interest rate be negative. And either will get you the stimulus, but the high inflation is going to mess things up. It's going to mess up the price system. It's going to confuse people. It's degrading the information content of the price system. So I've made the analogy between a computer and the invisible hand. So you're making your invisible hand that keeps all the details of the economy doing reasonably well more buggy if you have inflation in a lot of ways, and so that's not great. So it's better to have zero inflation. So the many prices in the economy are giving the maximum amount of information about what should happen, and then to have that one very important price of interest rates being negative.
So are you suggesting that inflation is almost always a natural consequence, or let's say a consequence of the way markets function, and that it's not, theoretically or, really enforced upon the system?
Well, it's a choice of the central bank. So Milton Friedman was interesting because in many ways he was a free market guy, but he said you do need to have a central bank. Now, he tried to make the central bank as mechanical as possible in order to make it seem free market. But let me describe the fundamental point as you want free markets, and free markets are a carefully designed system. Free markets don't come for free. You have to have a government carefully design a system in order to have a free market, and that can be seen historically. Jacob Sowell has a book about free market, the history of an idea, and he kind of talks about how that long process. But a free market takes a lot of construction. You have to think about how do we line the interests of each of the firms and individuals in the economy with the collective social good. That design, once you get that design well done, is a free market. And part of what you have to have in conjunction with the free market is a central bank keeping the overall level of demand in the economy in line with what is able to be produced.
So if we were to really pinpoint on the objective of the central bank, it's just to make sure that there is no excess either on the demand side or the supply side, and to make sure that things happen as per a set, of regulations, right?
Right. And then it's a somewhat separate choice of the central bank what the long run level of inflation is. So the central bank kind of does two things. One is stabilize the economy. And that's what we've been talking about, trying to make sure that aggregate demand is in line with aggregate supply. And then the other thing is it can choose the overall level of inflation. And if it has negative interest rates in the toolkit, then the obvious rate of inflation to choose is zero, because that makes the economy function best. If you don't have negative interest rates in the toolkit, central banks say, well, we need at least 2%. Now, some people argue for higher, but if you don't have negative interest rates in the toolkit, you're stuck with higher inflation as the best choice. But I want to, having mentioned the supply side, I want to say that's in the title of my blog, Confessions of a Supply Side Liberal, and that you want to increase the supply side. So that's one of the great virtues of having a central bank keep the economy on an even keel in terms of getting aggregate demand to equal aggregate supply, is then the rest of the government can be focused on trying to increase aggregate supply, trying to make things better in a long run sense. Recessions are a big distraction to governments.
But in a sense, when you say that, let's say in a moment of deflation or in a moment of, let's say, zero inflation, when you, let's say, impose negative interest rates and you are allowing for more things to happen on the supply side, but how do we sort of make sure that there's a corresponding demand on there's a corresponding reception on the demand side?
Yeah, that's a great question. And by the way, this hasn't been done that as well as it should have been historically. So I have a paper with Shushanto Basu and John Fernald called our technology improvements contractionary. And basically, if you don't raise aggregate demand when you have an improvement in technology, you can get a recession. But there's no reason a central bank shouldn't increase aggregate demand when you have an improvement in technology. If aggregate supply goes up, you should make aggregate demand go up. And central banks, well, the historical record is the Fed didn't do that as well as it should. Now, whenever I sounds like I'm criticizing the Fed, I want to be careful of saying they're doing the best that they know how at the time. And sometimes it's heroic trying to get to the next level of things, but we need to go to a level. We need to also go to a level higher than the one we're at now. So monetary policy could be much, much, much worse as it was during the Great Depression in the 30s, but monetary policy could also be quite a bit better than it is now.
But when you say that the moment the aggregate supply goes up, there's a natural sort of ripple effect, so that the aggregate demand goes up. Aren't we sort of making an assumption here along the lines of saying that demand does not exist today, or consumerism is sort of, let's say, going down the rails primarily because there's not enough money to spend?
Well, right. So then the question is how you get aggregate demand to go up, and the answer is pretty simple. You cut interest rates, and so let me explain how that works. So sometimes one of the interesting things about negative interest rate policy is all the old issues in monetary theory come back, because things that nobody had questioned in the positive interest rate range, like that cutting interest rates would stimulate the economy, suddenly people say, oh no, but cutting interest rates into the negative region can't stimulate the economy. But if you just have to do two things. You have to take care of the paper currency problem, and you have to take care of the bank profits problem. And if you take care of those two problems, interest rate cuts will definitely stimulate the economy. The bank profits problem is simply, which is the first thing that folks worry about. And there's a paper on the reversal rate, which is saying the bank profits problem is so bad that cutting interest rates below a certain level will actually make things worse in terms cut aggregate demand. But that's as if central banks were stupid about the bank profits problem, and central banks aren't stupid. If banks' balance sheets and would be really hurting, it's really easy for central banks to be nice to banks in various ways, to the private banks in various ways, so that they don't go bankrupt. It's really easy to devise ways to effectively throw money to the banks. And central banks routinely do that when they have negative interest rates. I'm not talking about some imaginary policy. I'm talking about current policy. Whenever the standard policy, whenever you go to negative interest rates, is you take care of the bank profits problem. Okay, so that's not a real world problem so far. You could imagine some central bank in the future being more stupid than actual central banks have been, but it hasn't happened yet. Banks are really worried, but and to be clear, that bank profits problem, lower interest rates help banks out in a lot of ways. There's only one way that it makes things hard on them, and that's that if they want to, they don't like to have negative deposit rates, because that might really alienate their depositors. And so at some point, if you had really deep negative rates, banks would have negative deposit rates, and then they'd make money off of loaning funds out at -2% and giving the depositors -4%, and there wouldn't be a bank profits problem. But as long as the banks have it at zero, but I'm actually okay with. I think there are some advantages to the banks keeping the deposit rates at zero, because for quite a while. Because that makes regular folks freak out less about the negative interest rates. And I think having the central bank we've proposed, Ruchir and I have proposed having the central bank subsidize the private banks so that they can afford to keep providing zero interest rate deposit rates, even when negative interest rates are negative generally up to a certain point. You can't do that in an unlimited way and have negative rates, but you can do it up to the amount of and beyond the amount of a typical checking account.
Got it. So you're basically telling that there's two problems to be solved. One is how do you deal with paper cash, and second is bank profits. And you're telling that the problem of bank profits is something that needs to be solved by design, and it can this design can very well sort of incorporate elements of negative interest rates, and still you can make the system work. But then I would like to extrapolate this discussion and ask you, the easiest way to solve the problem of paper cash is to eliminate it.
And there's nothing terribly wrong with that problem. You'll find that's with that solution. Still, that's highly controversial so there are two issues with getting rid of paper currency. One is it's highly controversial, so you've got an extra political battle to fight.
Sure.
On the other hand, Ken Rogoff has argued it's good for crime control, and sometimes people say, oh, but eliminating paper currency is, and people talk about the issue of privacy, and the issue of privacy you can boil down to who you're keeping secrets from and why, and so the key privacy people want with paper currency, for the most part, is to keep secrets from the tax authority and to keep secrets from other criminal control things. Obviously, if you have a very bad government, it's good if people can keep secrets from the government, and if you have a very good government, then the government's trying to do useful things like get tax revenue so it can let's say help the poor or support scientific research. Then it's not so great to keep secrets from the government. And so anyway, eliminating cash is I'm not against that, but you don't have to fight that political battle. The other thing, if you don't want to, and you can make it a separate political battle. The other thing is what Ruchir and I have proposed is something you can do overnight, whereas eliminating paper currency would take time. And when you're in the middle of the emergency, it's quite likely that when we'll next need negative interest rates, it'll come. The big recession will come upon us quite suddenly, and there won't be time to eliminate paper currency. Now the less important you've made paper currency, the better. So central bank digital currencies are great, as long as you got to make sure you have a floating interest rate on them, right? Because if you have a central bank digital currency that has an interest rate of zero, you've created a new zero lower bound. So that would be a really bad idea. So you need to. I actually favor, for digital currency, what I favor is the central bank providing the backbone of the payment system and making and letting fintech folks do the interface, and fintech folks deciding things like the interest rate. So basically, if the Fed or other central bank made it really easy for fintech folks to have the equivalent of a reserve account, or you can also have things that are a lot like a reserve account that are with the overnight repo system that the Fed has, and that's relevant to some of the legal issues around negative interest rates, which we could talk about later. So central bank digital currency is great, but if it wouldn't be possible to do it in a stupid way where you built in an extra zero lower bound with your digital currency. Don't do that. But if you've got to have a floating interest rate, and that's what a reserve account is, right? A reserve account is a form of digital cash, but it's only available to banks, right? That's a way to think about a reserve account, is that it's digital cash that only banks are allowed to have. But you want to have regular people to be able to have digital cash. So you don't have to get rid of paper currency. So what you can do is to basically, my view is that at this point in our history, things are already electronic enough that electronic transfers of funds in various ways are the centerpiece of our payment system. And so paper currency is really living on the top of electronic money anyway. And so at the cash windows of the Fed and other central banks, we have an exchange rate between paper currency and electronic money. And just by tinkering with that exchange rate, you can have a negative rate of return on paper currency. The way I've talked about it is like you can have a negative interest rate by having the paper currency deposit fee rise over time during the time when you need the negative interest rates. And then the paper currency deposit fee then goes back to zero. So that means when you go to the cash window to deposit cash, you don't get as good a deal after a period of negative interest rates. And so it's not like you have some arbitrage opportunity by holding paper currency, because let's say you take a lot of paper currency out at par, and then when you want to redeposit that paper currency, you're getting 95 cents on the dollar. Now, over that period of time, you've had a minus 5% nominal return on your paper currency. So really, paper currency has the value that it does because of what is said at the cash window. And actually, I mean, India, this is, I shudder to talk about this a little bit, because it's a very, very bad version of tinkering with paper currency. But of course, India demonetized certain bills, and as soon as they basically said, "Oh, you can't turn in this paper currency for electronic money," or it lost all its value. I mean, the way it went down, it was probably a little bit less clear theoretically than that. They just declared these bills are worthless, and then they became worthless. But if they declared they were worthless, but you could forever into the future always exchange them for electronic money, they would have maintained value. I mean, just saying the words they're worthless can't make them worthless unless you say we're not going to let you after a certain moment in time, we're not going to let you exchange these for other forms of money. So it's how paper currency is handled at the cash window. And the thing about this is, people sometimes think having a negative interest rate on paper currency, or negative rate of return on paper currency more generally, you'd have to do something all out in the economy. It would be all these rules and regulations. No, you just have to have the folks at the cash window of the central bank do things differently when they accept paper currency or disperse paper currency. That's all. It all happens within the central bank. The central bank. This is one more lever that the central bank can do, and you don't. It's the regular market forces take care of sending out those effects on cash to all the rest of the economy. And one beauty of this system, there are other ways to get a negative rate of return on paper currency that Ruchir and I talk about. But one beauty of changing the effective exchange rate of paper currency with let's say this paper currency deposit fee is even drug lords with big piles of paper currency, it reduces the value of their paper currency, because they can try to launder the money and get it into the banks, but banks, even for law-abiding folks, will be will charge an extra fee when people deposit paper currency, because ultimately they face a fee when they have to give it to the Fed. So paper currency everywhere has a different value, or of that jurisdiction. So dollars, if the Fed did this, dollars would have paper dollars would have a different value. Obviously, that wouldn't affect the paper currency of other countries.
Got it. So you brought up this idea of telling that the central bank need not have these reserve accounts allocated just to the couple of these banks that we have today, but independent fintechs can each have a reserve account, and they can sort of operate as a larger pool of banks, but at smaller scales. How would it be very different from, let's say, each individual having a reserve account with the central bank? And the reason I ask this is primarily because when we speak of, let's say, paperless transactions, or to a fair degree, mostly online transactions or electronic transactions, what's really the role of banks in this place? Why can it not just be one central bank with each independent, with each individual just dealing with transactions on a P2P basis without requiring, of course, we might need fintechs to build interfaces and many other stacks so that we find it easier to use the system, but it doesn't mean that they need to have a treasury for it to operate.
Well, so I actually favor having, the key is for the Fed to be offering this payment backbone to fintech, and you obviously need to have regulations for financial stability. But the idea would be, if you are a fintech company that has almost all that puts customer assets into the equivalent of reserve account. So it could be in the overnight repo system, but if they put the funds in the equivalent of a reserve account, then they don't have a lot of other regulations besides, obviously, some sort of reporting for anti-terrorism and so on. So you'd have some reporting requirements and requirements that you basically, for every customer dollar, you have to have a dollar's worth of the equivalent of reserve accounts, and then let the fintech folks figure things out. So the Fed doesn't have the expertise, and shouldn't have to have the expertise, of how to deal well with retail customers. What you want is to really, really encourage a fintech to build out, and you want to make payments. You want to make payments really, really easy and reliable and trustworthy, and not. So it's that payment backbone that you really need. Now, I suspect that there will be other countries' central banks that will do direct accounts for individuals, and there's nothing terribly wrong with that, as long as you have the floating interest rate. If you get people really used to the zero interest rate, then that's going to be a zero lower bound, or that's going to create a new zero lower bound. This is a bit of a problem with things now, like in Japan, you have postal savings accounts. So then you get a situation where the government has to be the one to say, oh, you can't have a zero interest rate on unlimited amount of deposits. I'd much rather have the private bank doing the job of telling people, sorry, you can't have a zero interest rate on unlimited amount of deposits. At some point, it's going to go negative. I actually think that the private banks and fintech would be a lot better at breaking that news to people gently, that you couldn't have $10 million at a zero interest rate when the going interest rate is minus 3%. They're just going to be much, much better at breaking that news to people than the government would be, than the Fed would be.
So in a way, you're suggesting that. Sorry, yeah.
Go ahead.
So in a way, you're suggesting that the role of these fintechs or any banks whatsoever is just to sort of improve the operational efficiency and to cater better to the needs of the retail consumers or the customers.
Yeah. But providing this payments backbone is really important. So I often think if we had, in the US at least, if we had a 2% national sales tax, that would be a big deal politically. And yet we let credit card companies do the equivalent of a percent or two national sales tax. They take a cut of all the transactions. And it doesn't have to be that way. If you give the payment backbone to fintech companies so that then it's easier to innovate, then you can go to the store and you can pay with electronic payments, and the merchant, the store owner, doesn't have to pay a cut of her hard-earned money to the credit card companies. So you have the Fed, the central bank, provide the safe, fast payment backbone, and then the fintech companies need to come up with something that people can basically install on their phone on the spot, so that the merchant could. And I mean, it's a little tricky because then they have to somehow create the link to their regular bank account, so that but you need an app where you get to the store, you're surprised, and they say, "Hey, look, we need you to sign up for this app. You can either pay cash, or you need to sign up for this app that instantly gives you the equivalent of a debit card." So I guess one other thing that's necessary is for the Fed or other central bank to worry about is a way to very quickly verify that somebody owns a particular checking account, a particular bank account. But then the payment system at retail can transform very quickly if you have those two things: the payment backbone and a way to very quickly verify that somebody owns a bank that's hooked into this payment backbone.
So do you also think that the Fed should try and allow each of these fintechs to sort of become a unique lending arm by themselves?
I think that's totally separate. What I want is the Fed should mainly, what's the highest priority is payment fintech, not lending fintech. Lending fintech is not, to the extent the Fed has anything to do with lending fintech, it's as a financial regulator and not as a central bank. But as a central bank, the Fed should be eager to encourage payment fintech. Why? Because the bigger fraction of transactions are done electronically, and the less is done by cash, the easier it will be for a central bank to go to negative interest rates when it needs to. So you can't go to if you go to deep negative interest rates without changing paper currency policy at all, you're likely to get problems. You're going to get large scale paper currency storage. The interest rates might not go as negative as you want them to go. Honestly, we don't know, because no central bank so far, maybe it's easier than people think, but no central bank has been willing to try going to low enough negative interest rates that we've had a serious paper currency problem yet. So we don't know at what point you get a serious paper currency problem, but presumably at some point you would. If interest rates were negative 10%, people would be storing massive amounts of paper currency with zero change to paper currency policy. If it were minus 3%, nobody knows whether you have a serious paper currency policy problem at minus 3% or not. Maybe you do, maybe you don't. But, in the models, it's like the zero lower bound is just, you can't go below zero interest rate. Well, that's not true. The central banks have shown that, and modifying the models to you can't go below minus 1%. No, we don't know that.
Right.
Presumably the problems would arise somewhat gradually.
But to a fair
still,
degree, would
you want to change paper currency policy. And changing paper currency policy goes down easier as a pill if paper currency is less important. If you can get most payments to be electronic, then modifying paper currency policy is easier. For example, Sweden has a very high fraction of electronic transactions. That's one of the countries best prepared to change paper currency policy. They didn't, but they could have, I think, without a big uproar.
Right. So, in a way, are you also trying to suggest, if we go back to our earlier conversation and let's say just printing money and distributing, part of the deal with negative interest rates sort of being more sustainable, quote unquote sustainable, compared to, let's say, just printing money is the fact that you have something to back up these amounts or the capital that you're lending, although with a negative interest rate.
Well, that's interesting. So printing money, in some sense, the printing money was, can printing money take care of things or not is an interesting question. And
answer is probably no, right? Because
in theory it could, but it might require buying a very large range of things. So if you had a central bank that was willing to buy, certainly if the central bank buys up enough foreign currency, it can create inflation. The trouble is that that's a bit of a zero-sum game. It doesn't work if all the central banks in the world are doing it, as would have been needed during the Great Recession. So that works. If you started buying up lots of stocks and real estate and everything, eventually you could create some inflation. But during the Great Recession, the central banks did a lot of creation of money, but they were, like the Fed only was buying long-term treasury bonds and mortgage-backed securities, and that was pretty weak medicine in terms of stimulating the economy. There's a debate about how much effect this had. Some people think it had almost no effect. Some people think it worked pretty well. But at any rate, it was surprisingly hard to generate inflation by money creation. And so one of the virtues of negative interest rate policy is not only that it means you don't need it. The fact that you don't need inflation is good in two ways. One is you can then have a long run rate of inflation of zero, which is better. The other is maybe it's hard for you to get inflation when you want it. Maybe you kind of get inflation when you don't want it, and then when you do want it, it's kind of hard to get it. And
but when do you want inflation?
Well, they did want. Japan officially had inflation of zero and officially said we want 2% inflation, not zero. And so it's the one country where they're not. The central bank, the Bank of Japan, is not sad that inflation has gone up, because where the whole rest, most other countries are saying, oh no, we've got higher inflation. In Japan, it's like, wow, it was really hard. We had inflation at 0 or minus 1% for a long time. We could never get it up. And finally, it's going up. And so the Bank of Japan is one place where they shouldn't be raising interest rates to rein in inflation, given their target of 2%. And look, I'm for negative interest rate policy instead of inflation, but I mean, I can see that they're not super eager to do negative interest rate policy. And if they're not going to do negative interest rate policy, then 2% inflation is better than zero for Japan. Yes, if they've been willing to do deeper negative interest, they did do negative interest rates to minus 0.1%, which is not very much. I mean, sometimes people say, oh, Japan went to negative interest rates and it didn't have this huge stimulative effect on the economy. Well, a basis point is still a basis point. If you go down 10 basis points or 0.1%, that's only 0.1%. In the positive range, nobody thinks that cutting rates by 0.1% is going to have some massive stimulus to the economy. And there's no sudden magic that 10 basis points or 0.1% is going to suddenly have a massive effect just because it's from 0 to minus 0.1%. But quite regularly, historically, minus 5%, a cut of 5% or 6%, 500 basis points or 600 basis points has done a lot of good in getting countries out of recessions. And that'll work just as well in the negative range too, as long as you have taken care of the bank profits problem and the paper currency problem. So if you're at zero and you're in a serious recession, zero interest rates and you're in a serious recession, go to minus 5% and your recession will go away, most likely. You know, if it's really terrible and everybody's really scared and everything, maybe you have to go to minus 7%, but you're going to be fine. So, and we know that from what's happened with interest rate cuts in the positive region. Now, I'd love to tell you theoretically why interest rate cuts are powerful, because all the old, as I said, all the old monetary theory issues are new again when you get to negative interest rates, things that nobody questioned, that, you know, nobody questioned that that cutting rates by 5 percentage points would stimulate the economy a lot in the positive region. And now people question whether cutting rates by 5 percentage points in the negative region would stimulate the economy. Well, the answer is yes, it will. And I can tell you why. So here's the mechanism. And this is based in part on, I think, I'm not sure I'm going to get the name right, but Adrian Auclair's work. But I've added some things to it. So basically what interest rates cuts do is they change the balance of power between borrowers and lenders. So if you have, so interest rate cuts are good for borrowers and bad for lenders. And now, you know, if they have a very long-term contract, maybe it'll make no difference because it's just locked in for a long time. But many times people are having to roll over, roll over a loan, or you have a floating rate loan. So you don't get a lot of interest rate stimulus from long-term contracts that can't change. Now of course, if in the US, you can refinance mortgages. So that's a long-term contract that you can change, at least one side can. And so that's actually very important. And so people can refinance their mortgages at lower interest rates when interest rates go down. So now the borrower's better off. I've refinanced my mortgage at a lower interest rate, or I have some other kind of loan that I've refinanced at a lower interest rate. And now I'm better off as a borrower, so I can afford to spend more. And of course, the lender is worse off, and so they can afford to spend less. But guess what? Borrowers are better at spending than lenders. That's why borrowers become borrowers, because they have ideas about how they want to spend money. Lenders become lenders because they want to save their money, and they have fewer ideas about how they want to spend their money right now. And so you're shifting the balance of power towards people who are good at spending money, and that's going to stimulate aggregate demand. And then what's called the substitution effect, that's an offsetting, that I call that countervailing wealth effects. You have countervailing wealth effects. So a lot of the borrowers getting better off counteracts the lenders getting worse off. So people who want to argue that the interest rate cuts won't work focus only on what's happening to the lenders and forget what's happening to the borrowers. And then what's called the substitution effect is on top of that countervailing wealth effect that ends up still shifting the balance of power towards someone who spends more, who's better at spending, the borrower. And then you have the substitution effect, which is simply there's an incentive to spend more now, because actually with really low interest rates, it looks relatively cheap to spend now compared to spending later. So because your money's going to shrink if you wait till spending it later, so that makes it look attractive to buy it now. That's the substitution effect. So that's like gravy on top. But these countervailing wealth effects, where the borrower's superiority at spending, that's kind of the heart of how you can guarantee that lower interest rates will stimulate the economy. And this whole story, so you have to focus on borrower-lender pairs analytically. Don't let anyone talk about only the lender. Force them to talk about the borrower and lender pairs, and then you can see that it's going to be stimulative. It's very, very rare to have a borrower not have a higher margin. It's very, very rare to have a borrower not have a marginal propensity to consume greater than the lenders. So that's analytically why interest rate cuts are clearly going to stimulate the economy. And if you want to overturn that, you can try to come up with cases where the marginal propensity to consume for a borrower is lower than the marginal propensity to consume for a lender. And it's a good challenge. I'm not saying you won't find any cases. It's going to be tough for you. You'll find one or two, and they're typically not going to be huge. I mean, there's the one case that I can think of that's a big deal, only really becomes relevant in hyperinflations. So one of the key borrower-lender pairs is actually the government borrowing money from bondholders, okay? And that's a borrower-lender pair. So part of the monetary policy transmission mechanism, as they call it, is the fact that if interest rates are cut, then it reduces the government budget deficit. And most governments are then going to say, well, our deficit's lower, we can afford to spend more. And interestingly enough, with a long lag since the financial crisis and the Great Recession, the U.S. started to say, oh, interest rates are low, we can afford to spend more. And then they kind of overdid it and helped create the current inflation. But at any rate, so I expect that the governments noticing that interest rates are low so they can afford to spend more will become an even stronger thing in the future. But even if it just works through the official deficit figures, you're going to get the government spending more and probably at a higher marginal propensity to consume than the bondholders. Now, what happens in a hyperinflation? And it's easy for governments to spend more money. Spending less money can be kind of tough. So if interest rates go up, what needs to happen? Part of what typically will happen and needs to happen is for the rest of the government, out besides the central bank, the fiscal arm of the government, to cut back on spending on other things to make up for the fact that it has to spend more on interest. And so that's typically what happens, and that's part of how raising interest rates can reduce aggregate demand. Occasionally, the fiscal arm of the government doesn't cut the spending on everything else when the central bank raises interest rates, and then you can get into a hyperinflationary situation. Now, notice what's going on there is you've got a lower marginal propensity to consume, or in this case, a marginal propensity to reduce consumption in the face of those interest rate increases than the bondholders. So if the bondholders say, "Yippee, I've got higher interest rates, I can spend a little bit more," and the government hardly cuts its non-interest rate spending at all, you could, and you occasionally do have a government that's cutting its spending less than the bondholders are raising this spending. But see, that's an example that shows how analyzing it by these borrower-lender pairs can be useful, even for the cases where this fails. But I promise you, with cuts in interest rates, it's pretty easy. It would be very strange to have a government that didn't increase its spending when you had those cuts because of the cuts in the interest rates. Now, they might be doing austerity for other reasons, but so you've got to compare austerity with higher interest rates to austerity with lower interest rates. I'm going to claim that the austerity with the lower interest rates won't be as fierce austerity as the austerity with the higher interest rates.
Right. So I think there's a very interesting point. So you're suggesting that borrowers are much better at spending, and the moment you give them more liquidity, they're able to do better with it and drive the cycle sort of in a more, let's say, accelerated or efficient manner. But then one thing I'd like to ask here is, okay, when we speak of negative interest rates, the best case scenario is to have a zero inflation. But you mentioned scenarios like, let's say, in Japan, where they did not want to go with a negative interest rate approach, in which case the idea is to have an interest rate as low as possible. But then how do you sort of determine what is this ideal number, or what's this ideal interest rate, and how low is low and how high is high? Like, what is just the right number, especially so in a free market?
Well, so the beauty of thinking through negative interest rate policy is that I can just, I don't have to have the answer to that. I mean, there's a staff of hundreds of economists at the Fed, and that's their job to figure out the right interest rate. Now, at the moment, I think it's too low, right? So I have opinions just like everybody else, and so I'm happy to put my opinion in. But I think of my opinions are much more about overall approaches to monetary policy than about what the interest rate should be at any moment. Now, right now, I think it's so obvious that the interest rate should be higher that I speak out about that. But a lot of the time, I think, well, I don't know any better than the Fed about what exactly the right interest rate is. But I mean, so there's this Taylor rule that says the interest rate should have been deeply negative in the Great Recession, and it should be a lot higher than it is now. Well, that's better than the monetary policy they have been pursuing. The Taylor rule is a description of what monetary policy was like during what was called the Great Moderation. So we had a period that seems, in retrospect, like a golden age of monetary policy. Now, I think we can do even better than the monetary policy in the Great Moderation, but that was pretty good. And describe the description of monetary policy during a period where we got outcomes as good as the Great Moderation. We can be pretty confident that that's better than what we're doing now, because the outcomes we got during the Great Recession weren't that great, and they were because of not going to negative rates. Now, I realize that it's a big, hairy deal to go to negative rates, and so, so to dramatize things, I obviously needed to say that the Fed should have done negative interest rates, but I understand how things really work. You're really kind of preparing for the next crisis. You have to point out how much better it would have been, during the Great Recession. I needed to point out how much better it would have been to have deep negative rates in order to help us get ready for the next crisis. And now in this situation, the lack of negative interest rates has caused trouble again by making the Fed scared to raise interest rates quickly enough. I mean, honestly, 0.75% per time isn't that bad if they were saying they'd go up to a top interest rate that was more like 7%. They'd say, look, we'll do whatever it takes. We'll go up to 7% if needed. We'll go 0.75% every meeting. That's not terrible. I'd go up faster. It'd be a great thing if they did 100 basis points, a full percent in a time, because that would tell people they could when they needed to. And so that would be a very, very good thing. The bigger problem is that the Fed is making people think they're going to top out at 5% or a little higher, which probably is inadequate because that's barely above inflation. And so you probably will still have quite a bit of aggregate demand.
Okay, so maybe I'm hitting a tangent here, but then I'm curious to know, when we speak of, be it inflation, deflation, primarily what we're telling is we're trying to define a value for currency, right? We're saying that X amount of currency is able to buy Y amount of things or commodities or services in a free market. And then this sort of, stumbles upon the question as to how exactly do you arrive at the value of things, right? Because primarily when we speak of, let's say, the idea of currency versus lending, especially in a country like US, where, the value of the currency is sort of determined by how much debt is being issued by the Fed or by the Central Reserve. So what's the ideal way to sort of, back the value of a currency?
So first of all, I think it's by and large okay to think in terms of interest rate. So interest rate policy is a reasonable way to do monetary policy, and it's pretty universal now. And then secondly, as I said, the Taylor rule is the starting point. Taylor rule would be better than what we have been doing, and it said deep negative rates during the Great Recession and much higher rates than several percent higher rates than we have now. And so you start with the Taylor rule. Then I have a paper called Next Generation Monetary Policy that says, in addition, it talks about negative interest rate policy as the first thing, but then goes on to talk about 8 other things that we should do to maybe do better than the Taylor rule. So let me talk about some other things we should do with monetary policy. So this is all in answer to your question of how you should do the interest rate. And I think, first of all, you do want to think systematically about it, think in terms of rules and kind of minimize the discretion you need. So what I propose in next generation monetary policy is you have a rule, but the only thing that the rule means is like you could have even in statute that the central bank has to have a rule, and that whenever it departs from the rule, it has to write up an explanation of why it departs from the rule. So I don't want to tie the central bank's hands, but I do want them to, whenever they depart from the rule that they have established, I want them to have to produce a document about why they departed from the rule, because then you can learn. It's like science. You could learn more from experience. So I think we should have that kind of a rule. If you make the rule, if you depart from the rule, you got to explain why you departed from the rule. I think that would be very educational for the public as well. Okay, then how would I make the rule different? First of all, I would have interest rates. Okay, no negative interest rates are fine. That's number one. Then I'd have negative interest rates go up and down further. And there's some evidence that this helps. So if you just look in the past when, for whatever reason, the Fed moved interest rates up and down further, it looks like the macroeconomic outcomes were better. You got quicker stabilization. So move. When I talk about that in Next Generation Monetary Policy, I cite another team's paper about that. So move interest rates up and down more, move them quicker. I think if you think that, like the Fed now says, oh, we're probably going to go to 5% or a little more. Well, if you think you're going to go to 5%, just go to 5% now. And I tweeted this yesterday, Jerome Powell said, oh, we don't want to be in a position where we have to cut rates. There's nothing wrong with saying, look, we went too far, we're going to cut it back. Because if you know you can if you know you can backtrack if you go too far, then you're not timid about going to a high enough rate. You don't want to be timid. If you think it's terrible, terrible, terrible to backtrack, then you will be too timid. A commander who has made a rule that they can never retreat is going to be too timid in going into battle in the first place. You need to be able to retreat. You need to be able to turn on a dime. You need to go up one be able to go up one meeting, down the next meeting, up the next meeting, if the situation calls for it. You should go to the interest rate you know you're going to. Well, truth be told, that's here. I'm getting all, you know, I'm speaking louder about this, but that's truth be told, that's one of the less important things. Moving interest rates up and down a lot is more important. I mentioned before about how you need to keep your eye on technological progress and stimulate, stimulate the economy more when you've had additional technological progress. You need to be focused more on durable and investment goods prices than the Fed is, because investment and durable goods purchases are really important for economic fluctuations. So I have a set of other proposals, but more vigorous monetary policy is kind of the main theme after negative interest rates. Be willing to move interest rates a lot, be willing to move interest rates fast. And so now is a period of time when just those principles of be willing to move interest rates a lot, be willing to move them fast, makes it easy for me to say the Fed should be raising rates more.
So do you think the sort of, highs and lows in the interest rates and sort of fluctuating patterns of this is effective because it's sort of maybe just a hit and trial to achieve at, the ideal interest rate in a much faster way?
Yeah. You just get it done faster. Get us out of recessions faster. Stop inflation faster. I mean, imagine if, I have a lot of sympathy for the Fed during the pandemic. It's like, this is something new. You don't know how it's going to look. You better err on the side of overstimulating the economy. Okay. But now let's get to December 2021. December 2021. By December 2021, it's clear that inflation is pretty bad. Okay. If in December 2021, you raised rates to 2.5%, let's say you jump all the way up to 2.5% immediately, maybe that would have taken the wind out of the sails of inflation. It would have been really dramatic. And you say, look, we're not necessarily, you could have even said, look, we'll watch the data. Don't assume we're going to raise rates more than 2.5%. We're doing something big precisely because we hope that it will nip inflation in the bud, and we'll look at the next bunch of data about whether inflation is nipped in the bud. That kind of shock and awe of going up to going up a couple of percentage points in one meeting might have done it. Wouldn't that have been a better outcome? No, we don't know what would have happened if we'd done that. But another thing is, the economic models say we ought to be doing experimentation, right? I mean, you got to be a little careful. And, there's always a balance, what's foolhardy and what's too timid. And I think it's pretty clear that central banks do too little experimentation. One of the things that I've been amazed by is how monetary policy is kind of global. It's like most central banks are doing the same thing at any one time. I mean, yeah, there are minor variations, but they're kind of thinking about it the same way. They're often literally doing things the same. And so we, even including all the central banks in the world, we get less experimentation than we would be good. We ultimately, we can't fully understand monetary policy unless there's a certain amount of experimentation. And there are lots of good reasons to think negative interest rate policy would work really well. But ultimately, some central bank has to be brave and try it. And then the other central banks will say, "Oh, now we've got solid evidence that it works." I'm in the middle of reading Ryan Holiday's book, Courage is Calling. And I think all central bankers should read that book, because there are times when courage is required by central bankers. You have to do something that's different than what you've done before in order to deal with a big situation. And of course they do. I mean, I don't want to minimize the amount of courage there was in the innovations of quantitative easing during the financial crisis, nor and I want to give them credit for a lot of the courage in doing new things to try to deal with the pandemic. But more courage would be good, even than what they displayed.
So in a way, we're saying that it's not just the borrowers that need to take risk, even lenders need to take risk.
Well, yes, yeah, and central bankers need to take risks. Yeah. When you talk about taking risks, I mean, one of that's a good way of thinking about. Another good way of thinking about negative interest rates. So think about a situation like the Great Recession again. So the idea of negative interest rates is to make it so there is no place to hide from the negative interest rates and the negative rates of return, except by doing real investment in the economy, like building a factory or designing new software, or possibly buying assets in another country, which is going to increase net exports, because the capital flow. There's an identity about capital flows equals net exports. That's well, there's the identity side of it, and then causally, capital flows cause net exports. So there's if things look really risky, you might have to have interest rates be quite low so that it's like, okay, I can lose a lot of money for sure with the negative interest rates, or I can take a risk. So and that can be really helpful if people are much more willing to take risks if they think the alternative is to lose for sure. Now maybe occasionally that makes people foolhardy, and that's why you need to have financial stability measures too. You have to make sure that people are risking their own money and not somebody else, not in some fraudulent way, risking some fraudulent or hidden way, risking somebody else's money. I mean, there's a lot there. I mean, one of the things, speaking of financial stability, so there are. This is an important. Complementary measure to negative interest rate policy. So negative interest rates and very high equity requirements, sometimes called capital requirements, but equity requirements say you need to be getting, a bank in particular, but maybe other firms too, have to be getting a certain fraction of their funds from stockholders. The virtue of forcing banks and perhaps other firms to get a lot of their money from stockholders and not to have too much debt is that stockholders have signed up to take risk. You want to make it very explicit that people are facing risk, and having it be stock rather than debt is one way to make it very explicit that there is risk there. And so forcing companies and forcing banks to get a lot of their money through stock where they have to admit that there's risk is better than letting them get a lot from debt where they're pretending there's no risk. Pretending there's no risk when there is not a good way to have a smoothly functioning economy. You really want to have people explicitly say there's risk. When things go badly, stock works very smoothly. It just goes down in price. Whereas debt, if you have a lot of debt and the value of the firm goes down, then you can end up with bankruptcy, and that's a mess. So the stock price of a company going down is pretty smooth. I mean, not that they like it, but it's pretty smooth compared to bankruptcies and the sort of things that happen when you have a lot of debt. And so negative interest rates might tempt people to take extra risks that they shouldn't take. But if it's stockholders taking the risk rather than folks buying bonds who think that it's safe when it really isn't, then you get less trouble. Now on that, I mean, there's a funny thing about the word risk, because you hear people say, probably it's sometimes the same people, talk about risk in a very positive way and in a very negative way. It's like, oh no, risk, this is horrible, and on the other hand, oh, the risk taker, the bold. It's like, well, guess what? Risk has both of those aspects. And in particular, in the depths of a recession, you got a problem because people are taking too few risks. You got to encourage them to take more risk. Taking risk is good in a recession. That's why you need negative interest rates. I'm not talking about privately. I'm talking about socially. I mean, taking a risk in a recession can be dangerous for the individual. That's why you got to, through monetary policy, make it a better deal for people, right? You got to encourage people. And then in a boom, people are taking too much risk. You got to rein them in by raising the interest rates and saying, hey, you can get a pretty decent return safely. And so it's not that risk is good or bad. There's a right amount of risk and there's a right time for risk. In a recession, the nation, the society needs people to take more risk. Risk, you got to be acting like risk is good during the recession, at least socially. I recognize that privately it's scary, but socially, risk is good in the recession. Socially, risk is bad in the boom when people are taking too much risk. And so it's not that risk is always good or bad.
Got it. So when we speak of, again, maybe I'm taking a tangent here, but when we're talking about monetary policy, when we're speaking of inflation, deflation, all of these are kind of restricted from a national context. But when we speak of, let's say, the global context, what exactly do you think should be the objective, or at least in your mind, what's the objective of global economy? Or when we talk of a sustained global economy, what do you mean by it?
Yeah, so the object for the global economy is to get step one is getting monetary policy work so well that we've tamed the business cycle. Things will always happen. There will always be shocks, but if you have a shock that makes aggregate demand go too low, you quickly lower interest rates a lot. If you have a shock that makes aggregate demand go too high, then you raise interest rates quickly, and then you get it equal to aggregate, the aggregate supply. And aggregate supply, then step two is we do everything possible to make aggregate supply good. Now, occasionally there will be very large, sudden, temporary shocks like the pandemic to aggregate supply. And that's a good example of where we should do something about aggregate supply. It's really inexcusable that we're not doing more for pandemic preparedness. And I think this is something where the amounts, a modest amount of money could make a big difference. An extra $10 billion of preparedness for the next pandemic could make a huge difference. So if the U.S. government doesn't step up for future pandemic preparedness as much as it should, some other country should step in. There are lots of ways to help the world. So if the U.S. government is busy focusing on helping Ukraine, that's a worthy thing. But if it feels strapped fiscally because it's helping Ukraine, some other country that is less comfortable supporting the Ukrainians in a war could throw in money to help us prepare for the next pandemic. But no, that's a supply side policy to have pandemic preparedness. And one of the things that I want to say over and over again is I wish economists had a bigger role in pandemic policy, because here's what they would have said. They would have said, look at the amount we're spending for economic support. If we took a tiny fraction of that and spent it on attacking the virus itself, we could have been way, way ahead. And now the same thing is true for the next time. It's like, so the willingness of governments to spend on direct economic support during the pandemic was enormous. And yet they're not willing to spend a tenth of that for preparing for the next pandemic, which would, and that sort of thing would have great spillovers. You know, there are a lot of annoying viruses that are not life-threatening. It would be really nice if we had them conquered, right? If preparing for the next pandemic meant that that these annoying viruses were already taken care of, I mean, that would be nice. And it's well worth the money. So that's an example of supply side policy, but there are other supply side policies. I mean, I believe, like most economists, that there is a really high return to scientific research and to technological progress, and it's I mean, there are other things to be known about how to improve technological progress. There's a very nice book by Matt Ridley on how innovation works that I highly recommend. And it's you need to have, in a lot of ways, you need to have your society be ready for and supportive of oddballs who are going to do something new. How much you ridicule people for departing from the status quo makes a difference. Now, it's always going to be a hard row to hoe for an innovator, but you can make it less hard if you have and that's something that art can make a difference for. If you have movies that are about the hard-fought victories of innovators, and you're kind of nice to the innovator in the movie rather than making them I'm not saying you want to totally gloss over the fact if they're in fact jerks, and I don't think you need to be a jerk to be a great innovator, but if somebody's a great innovator and a jerk, you've got the balance of how much you focus on those two features, and it can make a difference. I mean, honestly, another kind of supply side effort is there are a lot of things that we know that we could do better. So I've written a lot on my blog about diet and health. I mean, I think there's a lot to be said there. I've recently read Taubes's book, The Case for Keto, which I think is a good book that talks about some of the evidence. I'm a fan of Jason Fung with fasting, and I think that we're still telling people, even people who have a tendency to obesity, that they should be eating 3 meals a day with lots of carbs. Well, how well has that worked for us? The trend lines of obesity have gone up. We've had this advice. People have followed this advice of, at least 3 meals a day, maybe more, and eating lots of carbs. And it may work for some people, but it doesn't work for most people. And so their scientific research makes a difference. It's like $10 million for a randomized control trial, and we can learn a lot from each randomized control trial. There's a supply side policy for you that, if you had a billionaire willing to devote most of $1 billion to solving this rise of obesity, I think that's a good way to turn $1 billion of philanthropic money into $1 trillion worth of social welfare, if not more than $1 trillion. I mean, just think of even just how much in the government budget is saved if Medicare wasn't in the U.S. wasn't having to pay for all the diseases caused by obesity and the insulin deregulation that's behind most obesity. I mean, that would be a huge boon to the government budget alone, let alone people not suffering under these horrible diseases. So that's a very big supply side policy right there. I mean, let's balance the government budget by improving people's health, by having better diet, by having decent diet advice instead of diet advice we've been giving people for half a century that clearly has been working very, very, very badly. Now it's intuitive diet advice, which is one of the reasons it's persisted very, very so long, but it's very, very, very wrong. And we know it's wrong because it didn't work. I mean, we've had enough of an experiment, half a century of telling people to eat eat lots of small lots of small meals with lots of fruits and vegetables and whole grains. Does not work. I'm sorry, it doesn't work. It works for some people. Okay, it works for the people who weren't very prone to obesity to begin with. It doesn't work for most people.
Right. I really like this analogy that you brought about, where you say that enough should be invested in, let's say, preparing to tackle the next pandemic as opposed to sort of dealing with it at the moment of crisis. And if I were to draw an analogy, it's sort of a way to tell we need to allocate enough funding or give enough grants for research to be done. And in a way, if I go back to, the narrative of negative interest rates are a way of telling, okay, I'm giving you periodic funding or grant for you to be doing something, but you figure out what you want to do with it.
Yeah. Well, let me tell you another area where I think we're far inside the production possibility frontier, and it would be a huge supply side policy. So notice how supply side policy is much more than what a lot of Republicans have called it, which is tax cuts are the only supply side policy. Well, okay, good tax policy is helpful. I mean, I think it would be a good thing if the U.S. had a VAT tax instead of our current tax system. So, I mean, tax policy can make a difference, but some of these other things are probably bigger. So here's another one. So I'm a big chunk of my research is researching well-being. Sometimes I call it the economics of happiness, but we're putting together the principles for a national well-being index. And one of the virtues of a national well-being index is that it includes in your measure of how well a country is doing, not just the stuff that runs through the market, but there are a lot of other things people care about. People care about having good marriages. They care about being in good health, right? And not all the improvement you get of not having obesity would be shown up in GDP. Some of it might show up in GDP as people had more energy and stuff, but a lot of it would just be people being better off, that in a way that didn't require money to show that they were better off. I mean, and that's a pretty hardcore way to be better off. But there are other things that matter too. So one of the things that we all know, but is useful to point out, is almost everybody, it's a rare individual this isn't true for, almost everybody has a little voice in their head saying, "You stupid idiot, why did you do that?" It's like the inner critic. And so, look, if people contain the inner critic, that's a lot of extra happiness there. And it doesn't take much. So I'm one of the things that I offer to economists, and I'd be happy to offer this to you too, is I do a free 6-week program on positive intelligence, which is a very great distillation of current psychological wisdom about how to deal with things like the inner critic and to have to identify your saboteurs. There's a lot of different saboteurs. Like I have one of mine is a controller. It's like I get all anxious when things might not go my way, and other people are not that happy about that either. So it's not great for relationships. So that's another example. But to bring out the creative the creative part of ourselves that loves life, loves other people, and to kind of tame the side of ourselves that's fear-based. And this is, I mean, look, it's a real advance. So I grew up with pop psychology. My mother was a dual major in psychology and sociology, and so we had these pop psychology books when I was growing up. I promise you that was low quality pop psychology. Now we've got this high quality pop psychology and this positive intelligence. There's a book of that name, and the good thing about the 6-week program that I'm offering for economists is you get to hear other people's experiences. And so one of the things you learn is everybody's got it tough. I mean, I'm not saying some people have it a lot tougher than others. I don't want to minimize that. But there's almost nobody who has a life that's easy in every respect. And we often don't talk about these things. But people have challenges, you know. I mean, in most ways, I'm an incredibly lucky man, and I've had 3 children die. And, you know, and I had to navigate a big change in my religious beliefs. So those are, and you know, I could say more, but that's actually totally leaving aside any of the usual any of the usual difficulties of childhood. So I didn't have to reach back into my childhood for those, but we can be compassionate to one another, and guess what? That would make a huge benefit to well-being. That's a supply side policy too. It's a supply side policy if we make people better off by helping them to deal with their inner critic. That counts too. And one of the things, our work on well-being, one of the things I tell our prospective research assistants is we're the high-tech well-being people. So what we do is we're taking fluffy stuff like feeling happier because your inner critic isn't going after you, and then doing a huge amount of math and statistics, and then we can we can show that that's worth, you know, if you want to get the monetary equivalent, it's worth a lot of money, and you know, you got to do that right, and in a more sophisticated way than the literature currently does, but you can get a monetary equivalent for that. And guess what? That's worth a lot of money. How much would you pay? How much would you pay if you knew for sure that you could have calm inside your soul instead of this constant war with yourself? And it's just not that hard. It does take a little bit of willingness to experiment with something new, but it's not that hard.
So I actually had questions on taxation, but let's stall that for a while. We'll get there. But since you brought this, idea of wellness and calm, and especially these coming from an economist, it's very intriguing, and I have some questions on that. So when we speak of the idea that you say that the idea of well-being or happiness itself is worth a lot of money, that in the sense that you might have to pay just an infinite amount for you to be able to get hold of that, but it's not that hard. That being said, isn't this sort of dichotomous with the approach of economics and saying that, economy or the growth in GDP is all about excess of consumerism? It's about incentivizing people to work more, to buy more, to spend more, and to again work more to sort of repeat this again and again. And
the great thing is that economists are actually more sophisticated than that. So it's an outsider's view of economics that it's all about money. But if you look in economic theory is developed around the idea of basically getting people what they want. That's the job. There are 2 jobs of economists. One is the scientific job, figure out how the world works in the social area. I mean, economics is a social science. So how does the world work in this social arena? And human existence. And then the other part of economics as a policy making aid is how do we get people more of what we want? One of the great things about economics is it's very non-judgmental. If you, in your heart of hearts, really want something, our job is to try to help you get that, and obviously in a way where it's mutually consistent. So those principles of freedom, where you have as much freedom as it doesn't interfere with somebody else's freedom, is part of how you get people what they want. And so in fact, economic theory is pointing at the full range of things that people care about as being economically valuable. And so we should obviously care about that. So this is really at the core of economics, that is about more than just money. Now, the thing that monetary transactions do is they create a lot of data. So, but partly that's because we've designed our statistical agencies that way. So our statistical agencies have put a lot of, it actually is a pretty substantial budget item for a government statistical agencies to measure GDP. And if we put a fraction of that towards measuring well-being more broadly using self-reported well-being measures, then we could get a lot more insight. And so our team was asked by this didn't actually happen, but our team was asked by the New Zealand Treasury to say, well, if we were able to get, if we were able to support you in this, we want to have a proposal we can talk to other agencies about what would be the ideal way to set up a national well-being index. And what we said was have a web panel, get a representative sample of people and survey them periodically about their levels of well-being, and have the ability for social scientists to add questions to that survey to try to get it, what causes what. Have the government roll out new initiatives in a way that allows you to do an experiment. So there's been some of this explicitly, but you don't want to have the new policy happen at the same time everywhere, because if you have it happen sooner one place than another, and you randomly sprinkled out around the places that it happened earlier rather than later, now you've got a good experiment to see what that policy did. And nowadays, where the thing we've been focused on lately is you need to just be very sophisticated. For example, different people use a scale differently, and so so you need to adjust for that, and that you can do. So there are a lot of technical issues that I could get into, but I don't need to. But right now, but then the reason I get excited about this is I think there's a lot of low-hanging fruit. I think there's a lot of ways to make people much better off that don't show up in GDP. So one simple example is there was a paper that tried to quantify get a dollar equivalent for the value of reducing domestic violence. It's huge. It's trillions of dollars. And you can see why. I mean, it's like, it makes people pretty miserable if somebody in their own household is beating them up regularly. That's a big, 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 hairy deal. They're stopping that is also supply side policy. In other words, the object for economists is and ought to be to make people better off and so honestly, I mean, I'm philosophically, I'm mostly a utilitarian. I'm sure I diverge from that from time to time. I think I've got a little bit of Stoic mixed in there philosophicing, but you can get a long way with utilitarianism, and I'm not. I hope I'm not too dogmatic about anything, so I'm not not saying utilitarianism is perfect, but you can get a long way with that. And it's not easy being poor. And so as soon as you go even a little bit in the direction of utilitarianism, you're going to be caring a lot about the poor. And so that's true in terms of the global poor as well as, so it's a fabulous thing to see poverty being reduced in China and India and Africa. And I think one of the things, there's trying to remember the name of this book, but there's a wonderful book by the man behind Gapminder that really talks about how the world really is getting better. I mean, okay, we could have a nuclear holocaust. Things could get much worse in future, but the trend lines that make things better are not things that get into the newspaper very much. Newspapers are very, very, very short term, very high frequency for the most part. And so we shouldn't be discouraged. Things are, broadly speaking, getting better. We have continuing challenges, and guess what? It was worse 100 years. It was worse 100 years ago. I mean, that's probably literally true. I mean, think of 1922. I mean, you had.
Yeah.
I don't know when the Nazis were beginning, but it was.
I think it was 1914 to 1919, but yeah.
Well, no, that's World War I. 1914 to 1919 was World War I, but then you had, things were pretty unsettled in Germany, and you had that hyperinflation, and you had the beginnings of the Nazis and stuff, and then not long after the Great Depression. So, I mean, things are bad. Things are bad now, and they were even worse before. And that trend line should give us hope.
So is there a baseline definition of well-being that you would think is applicable to the world?
Oh, yes. And it's quite, it's sophisticated. It's like, think of the definition of GDP. If you really get into the details, it's quite sophisticated. So you have the basic idea of GDP of, okay, we're going to get the total amount of goods and services produced in the economy. And then you have a lot of details. Same with well-being. So well-being, you say, look, what we want is something that represents people's preferences. So people sometimes, utility represents people's preferences. So you want well-being to be in line with utility, but that doesn't solve all the issues, because utility by itself doesn't automatically tell you how to deal with inequality. And so you need to get a welfare measure that's in part based on utility, but in part is based on additional considerations about interpersonal comparison. So that's one of the latest things on my blog, is about interpersonal comparison. And so it depends on how you want to use the terminology, but you start from the notion of preferences and utility and go on to interpersonal welfare in a way that allows interpersonal comparisons, and then you construct a social welfare function. And to get the part that's most like interpersonal utility, you need to have a variety of different aspects of well-being. So our teams, some of our teams' early research was saying happiness isn't everything, life satisfaction isn't everything. People will knowingly sacrifice life satisfaction for other things they care about. I mean, and this is obvious. It's like, people often do things that are really hard on themselves in order to help their families out. And so, and they do things out of nobility. I mean, that's, think of Stoicism, and it just was in that book, Courage is Calling. I was just here listening to the part in the audiobook about the 300 Spartans who defended against the Persians. Now, I mean, okay, was that good for their life satisfaction? I don't know how you even define the life satisfaction of people who are dead. And yet they were putting something as more important than their own narrow life satisfaction. And so that's important, to be noble and heroic, and there's nothing wrong with people enjoying material things. One of the things that I think is a little tendentious in some of the happiness research is they talk down material goods. Well, one of the things we find is rich, educated people care more about life satisfaction than folks who are struggling. If you're struggling, you have more pressing issues than life satisfaction, and we shouldn't design a national well-being index to just focus on life satisfaction, because that's kind of tilting it towards what the elites are caring about. And you want to make sure that you represent all the things that everybody cares about.
So there's a very interesting point that you brought about, right? That when we're designing, a well-being index, it doesn't always have to just include satisfaction, and things like satisfaction become more important when your survival or basic necessities are taken care of. And it's intriguing to me because I was reading this book called Poor Economics by Abhishek Banerjee, the Nobel laureate. And
he's a classmate of mine, by the way.
Oh, wow. Okay. So in the book, they mention about how in many cases, sort of incentivizing or giving away things in a rather easy fashion to, the so-called poor, or in a way kind of gives them more reason to not do anything.
Oh, I mean, there are lots of issues. I mean, how do you best help people? And I think there's an awful lot of productive debate about how you can best help people. And one of the things I want to stick up for here is personal responsibility has to be part of the story. And I've blogged about this. It's personal responsibility is one of those interesting things where people should take personal responsibility for themselves, and no one else should ever be allowed to say, oh, you need to take personal responsibility, so I'm not going to help you. No. You don't get to talk about other people's personal responsibility. You get to talk about your own. And you do get to talk about how can we encourage people to take in personal responsibility, but ultimately that's their own personal responsibility. It is blaming the victim if you're talking about other people's personal responsibility. It's not blaming the victim if you're encouraging people to have their own personal responsibility for themselves.
But how do you encourage them?
What?
But how do you encourage people to have their responsibility?
That's a great question. And I think that we kind of know the answer historically. So there have been, I'm not a historian, although my dad was. He was a law professor, and he wrote biographies in his spare time. But it's my understanding that, for example, there in England and the United States, there was a Sunday school movement trying to teach people to clean up their act, and that it actually had an effect. So I think the answer to how do you encourage people to take personal responsibility is to, I think we have a lot of historical examples where it worked, and then you can do experiments to see what works. There are charter schools, like there's the KIPP academies that do a pretty good job with this, and they will emphasize the importance of going to college, and they'll emphasize good behavior. And if a kid misbehaves, they'll immediately like stop everything and have an assembly where they talk about that. I just think a lot is actually known about this, and I think there's a certain amount of this is the area we need the wisdom from all sides of the political spectrum. And this is an area where there is some wisdom from often some wisdom from the right wing of the political spectrum. This area of how do you encourage personal responsibility? I think as I said, I think that charter schools are often pretty good at this. I think that religious organizations are often pretty good at this, and you have we have a left wing in the United States that sometimes wants to keep its distance from charter schools and religious organizations, and that's not healthy because you need the wisdom from all sides. It's one of the key principles of positive intelligence is you really need, everybody's likely to be 10% right. You really need to, you don't want to demonize your adversary. You want to find the 10% in what they're saying that you can agree with. And if you're not finding the 10% in which the other guy is right, you're destroying or you're disregarding an awful lot of wisdom. And so this is what's bad about America right now. And unfortunately, I don't think the United States is alone in this, but we have people talking in the political scene, we have people talking past each other rather than looking for the areas of agreement. More and more you have people saying, oh, I don't want to live there because it has too many people of the opposite political party there. So you're getting more residential segregation along political lines. This is not healthy. We need to be able to talk to one another. And that's why, I mean, that's part of what it means to me to have a partisan, nonpartisan blog. I mean, being a political independent and trying to find and communicate the good ideas of each side is, I think, a valuable thing. Now, it's you got a lot of partisans speaking very loudly on social media, in the public debate, but I was very pleased to see how big a difference independence made in the last presidential election. So, or sorry, not presidential election. I meant in the last midterm elections in the United States. So you had folks voting saying, "Look, we're not totally happy with what the Democrats are doing, but we only like the part of the we only somewhat like the part of the Republican Party that's not Trumpist." And so basically the Trumpist candidates couldn't get the independents by and large, and the non-Trumpist Republicans did very well. And that is healthy for the country relative to what it could have been.
So in a way, do you think that this sort of encouragement to take responsibility boils down to giving people something to aspire for and promoting a certain set of belief systems that's commonly agreed upon?
Well, I mean, I think of the genius of a true democracy as making it possible for people to get along and at least mostly stop short of violence, even when they believe very, very different things. So, before Obergefell v. Hodges, which legalized gay marriage throughout the U.S., I wrote a piece about how gay marriage is a matter of freedom of religion. Because I view religion broadly in terms of people's deep, heartfelt beliefs, and I blog about religion. If you ask me, do I believe in God? I say I believe in God as much as is possible for a non-supernaturalist. So I think that non-supernaturalists should have claim on religious liberty too, not just to not believe in God, but to have deeply held, profound views about how to make a difference in the world, what kind of society we should try to build. That needs to be respected. So you need religious freedom for folks who don't believe in the supernatural. And so believing that we should be nice to everybody, in the sense of, for example, it means a lot to gay folks to be able to be married, right? And it doesn't hurt you very much. So, I mean, maybe that doesn't sound very profound, but that is a utilitarian view. But it's just a pity if, for the sake of avoiding some small discomfort on someone's part, if you can't let folks love one another. And to me, that's a big deal. And so I think we need to have systems. We need to have a mechanism. That's what we want in constitutional government. We need a mechanism that allows people with dramatically different beliefs to live together nonviolently. And of course, that's a big deal in India, that you have religious differences. And I think it ought to be okay in India for some people to be true believer Muslims and other people to be true believer Hindus, and they should both be able to live together in peace. And folks who are, encouraging violence for the sake of political gain isn't that great. Now, it's also not great if you stand in the way of, regular economic progress that shows up in GDP too. So it's there are many dimensions of good and bad governance. So I'm not trying to weigh in on one particular party versus another. I'm just saying I am a policy by policy person. I'm not. I mostly try to avoid. I'm not 100%, because you heard me speak again. I mean, when Trump wanted to go against the U.S. Constitution, I said I can totally talk about the fact that I'm anti-Trump if he's going to be against the U.S. Constitution. And of course, he has a Truth Social tweet, the equivalent of a tweet that's even more explicit about that. But the January 6th thing, that it was already showing a willingness to go against the U.S. Constitution. And so, I mean, that's a bright line for me. But you can say it's not good to foment religious discord. What you want is for people to be able to debate one another. You want to have freedom of speech, vigorous debates that are nonviolent.
Fair enough. But I just want to go back to the point in taxation that you mentioned, right? You spoke about how you would support value-added taxes as opposed to, let's say, income-based taxes. And yeah. I sort of come from a similar standpoint, and I want to understand from you, how do you think expenditure-based taxation is better? And I also want to throw a counterpoint to that and say that if you sort of make taxation expenditure-based, you're sort of inhibiting people from spending. Would you agree with that? And if not, why?
Well, okay. Let's do the two sides of the question. So one side of it is, how much should you be doing? How much should you be taxing investment and capital accumulation? And I think there's and often I think economists have come down mostly to the idea that you should do fairly light capital taxation. So theoretically, the one reason to do some capital taxation is, I think it's easiest to tell it as a story. Suppose you have somebody who does a startup and becomes a billionaire. I mean, the thing you'd worry about is, are they going to have sufficient motivation to do the next big thing, or are they going to go live on a Caribbean island and just consume for the rest of their life when they have this potential to do something new? So I think you can. I mean, that's an issue you can think through, but it's not clear to me that taking away most of their billion in order to encourage them to do another startup is the way you have to do that. I think culturally lauding I think we should culturally laud people who get rich through legitimate means. First of all, we should make sure to make the rules so it's not possible to get rich by means that aren't improving society. And okay, we won't catch it immediately, but if you get rich by a means that's not helping society, we should have had rules in place that means we can throw them in jail. And so we have to design the rules carefully. I mean, it's not fair to make up the rules later on and just have a moment of disliking somebody and throw them in jail. So you need the rules in advance, but we should design the rules very carefully so that the interests of entrepreneurs are aligned with social welfare. And once we've done that, we should be happy when somebody gets rich. And then we want to encourage the rich to reinvest rather than to spend the money. So one of the things, one of the proposals that's I've sort of told you all of the biggest things that I think that I'm trying to work on to make a difference. And then the next one on the list would be, I think we need to don't use taxation to take money away from people in a way that's more painful than it has to be. So what you want is for people to be helping society. So for example, one simple thing you can do is you should celebrate the biggest taxpayer. You say, look, here are these people, they're paying lots of taxes. They're doing, not only are they entrepreneurs that have made the society better, but they're also paying a lot of taxes, and celebrate them. Have a dinner at the White House that's, give them medals for paying a lot of taxes. Then the other big thing there is, I think if somebody has become very wealthy by doing good for society, that they've earned the right to decide a little bit how they want to help society. And so what I want to do is you basically require very large charitable donations. Now, a lot of rich folks are doing this on their own, and that's great. But you basically say, look, we're gonna have this huge tax on you, but you can avoid all of it if you can get a 100% tax credit for that amount if above the usual tax. You've got the usual taxes, then above the usual taxes, you've got this large tax which can be avoided 100% if that money is given away to charity. So it's like you can either give the money to the government, or you could do philanthropic things with it. So I would hardwire philanthropy that way. And I think it would be good for people at all levels of society to do some of this philanthropy. Like, if you have a low income, then we expect you to only give a little bit to charity. And but I think it gets everybody thinking about how can I help? And I think it would. My view is that my prediction is it would quickly become part of the culture. People would get used to the fact that everybody was required through the tax to do philanthropy. Basically, it's like, okay, you just get taxed extra if you don't do philanthropy. Pretty much everybody would do it. I think people would get used to it. They would like it. I think there are rewards from giving away money. Emotional rewards. It can teach your kids to care about others. I just think it would have a huge good effect on the culture, and then the government just takes care of the things that it has to, the things that are left. So, who knows what people, you can try to guess, but there are going to be some things that are going to be more popular to deal with philanthropically than others. What the government should take care of is the things that need to be taken care of that people don't happily take care of philanthropically if you require them to do a certain amount of total philanthropy. So, maybe national defense can't be taken care of philanthropically. I don't even know that. Maybe people would be happy to donate their philanthropic dollars to national defense, but probably not. And so the government's got to take care of that. There might be groups in society who, for whatever reason, are unpopular. And so helping out poor, unpopular people might fall to the government. So the government fills in the gaps, but you take care of as much as you can by this required philanthropy and then have the government fill in the gaps. And I just think that the tax distortions that we worry about in terms of the supply side are people working less hard, saving less, perhaps, because they want to avoid taxes. If a lot of the extra that you owe isn't taxes but philanthropy, that's a lot more fun than giving money to the government. Philanthropy can be really rewarding. And so I think people won't try as hard to avoid required philanthropy as they would try to avoid taxation. And so you get less distortions. So you get lots of good cultural effects. Hopefully, I think it would raise the level of altruism in society. People, when they do good, become more altruistic, even if they're kind of nudged a little bit this is more than a nudge because it's required philanthropy, but it's, I think that people have a choice. They can either say, the government's forcing me to do this, or they could say, well, okay, I have to do this, but I'm a good person. I would want to do this anyway. And then they become more of a good person because they take that attitude. And so, but to me, that's a big deal. And that's one thing I wish I'd love to get allies in trying to foster that kind of an idea.
So why
it could matter.
Yeah.
Oh, go ahead.
No, you were saying something.
Oh, no, I'm saying it could matter even more to other countries because the U.S. is actually pretty good at having a philanthropic tradition and of giving money to charity. And not all countries do. And so this kind of a system could potentially make an even bigger difference in other countries. You could get people used to philanthropy.
Sure, but while we encourage systems to sort of support philanthropy or even motivate people to be philanthropic, but from a taxation point of view, you still think income taxes are the best way to go about it? Or do you think income taxes should be removed?
No, I'm sorry. As I said before, I think a VAT tax would be better. And so there, okay, I told you the biggest issue with taxation is having people give money to help society in ways that's less painful than taxation, and therefore will avoid less. With the virtue of a VAT tax is at least you're not penalizing investment, and there's not a big worry. You also asked about, will this discourage consumption too much? I don't think there's a big worry about that because people need to spend their money somehow. I mean, they have to either give it away or spend it on themselves. And so if everywhere you look, however you spend it on yourself, you have to pay the tax. It's not like you're going to not consume ever, right? I mean, maybe it would encourage you to give the money away. I think that depends a lot on your specific theory, but I don't think it particularly discourages consumption. Now, if you have a temporary VAT tax, that can discourage consumption and kind of varying. This is a little tricky to do, but in principle, if you have a little higher VAT tax in the boom and a little lower VAT tax in the recession, that can be a pretty decent countercyclical policy that I've emphasized monetary policy. If you wanted to do a little bit of varying the VAT rate, to have a countercyclical stabilization effect. There's nothing bad about that. But the discouraging consumption is mainly if you have a high VAT tax compared to later or compared to earlier.
Got it. So on a personal level, what does wealth mean to you? On a personal level.
Oh, you mean me personally?
Yeah.
Well, for me personally, I mean, wealth is freedom. So it's like, can I focus on the things that I think are the best way for me to contribute to society without without me and my family suffering, and to be efficient about things. So it's like, can we have can we have a house that's in a quiet enough place that we can sleep at night, for example? I mean, it would, my effectiveness as an economist would be less if it were super noisy and I couldn't sleep at night. So I think there is a way to spend money that's an intermediate good to what you think of as your mission in life. And then I also, let me say this, just because I don't want to paint too rosy a picture of, in some sense, I have more money than I deserve. I mean, don't tell my department chairman, but there are a lot of people who are really badly off. But one of my friends, I had taken a class on ethics, and they were thinking about, maybe you should transfer a lot of money to the poor. And what I told him was, look, what you can do in your career, it depends. But I said, many people, what they can do in their career to make the world a better place is greater than what they could do by giving away their money. Now, some people, it's the reverse. Some people they might be doing some company that is not doing something particularly good for society, but at least they can give away the money in a meaningful way. So sometimes there's the reverse, but I think there are many people, and I think I'm in this category, that I can do more good for the world through my efforts than through my money. That doesn't mean I'm not going to give away money to charity. I mean, it's like I've told my kids, don't expect too much of an inheritance because I want to give most of it away. So, and that's kind of what it looks like when you give away money. You're telling your kids to expect less, and unless you spend it yourself. I think I can make a bigger difference by my efforts than the money. And so what I told my friend was, if you could give away your money and devote all your time to really worthy big things, that's great. But if I had to choose between you giving away your money and giving away your time to the worthy things, I'd rather choose you giving away your time to the worthy things. So in other words, we don't want, for people in that category, and I think a lot of the people watching this podcast would be in that category, we don't want them to get distracted from doing the work that they are called to do to make the world a better place by giving away so much money that their own personal, somewhat greater poverty distracts them from the work they need to do.
So what is your idea on how could we, let's say, get to the idea of universal basic income? How do you ensure that everyone is at a certain pedestal before we think about more economic activity? And let's say hypothetically, if we hit that state of universal basic income.
Oh, I'm glad you asked this, because I have a clear opinion on this. So I am not I'm not a fan of the usual basic income. Obviously, at some level, a basic income is fine, but I think the trouble I have with a generous basic income is that I think work is good for people's souls, and so I'm much more inclined to do wage matching. So the idea here is, and this gives you an idea of the generosity. I would say, if you need to have lots of regulations and things to make sure people don't game the system, but that's all possible. If somebody genuinely earns $1 in the private market, the government also gives them $1 to match it. So you have wage matching. So you effectively double wages at the bottom. Not for people with really high wages, but up to a certain amount of money per year. Every dollar someone earns, you match it. Now this is one way to view this is like in US terms, it's like the earned income tax credit on steroids. So it's like not just, it's a refund. You could do it as a refundable tax credit. Now there's so Morgan Worsler is somebody you can see on Twitter who's designed a website to do this, and he's been pushing this pretty hard. So it looks like his Twitter handle is just at Morgan Worsler. So I was just looking on Twitter there, but this is kind of his thing. He's designed as part of his business, he's designed a website for this. And but the great thing about wage matching is, as I say, it encourages people to work. It gives them full freedom of what kind of work they do. And it's a supply side policy because it's a way of helping the poor. Some ways of helping the poor discourage work. This is a way of helping the poor that encourages work. Now you got to get the money from somewhere, and so it might be hard to do that with no tax distortion. So the fiscal cost is the one big problem. But I still think it's likely to be very much worth it. And so you get a lot of extra services and goods, and particularly at the bottom end. I think it would make life a lot less expensive for the poor, because you have people at low wages are probably especially have a comparative advantage at producing kind of basic services. You could even say low quality services that are the sort of things that the poor can afford. And so you make things really affordable because, it's like the poor would be providing services to one another in a way that was highly encouraged by this government wage matching scheme. And so that seems to me to be a good way to help the poor, because you're encouraging work rather than discouraging work. And I'd certainly recommend something like that for India. Again, there's the issue of the fiscal cost, but I think some form of wage matching, and then I don't know, it's it's a great alternative to the minimum wage. The trouble with the minimum wage, as all economists recognize, is there's got to be a high enough minimum wage that would almost shut down the economy. And then you can debate about what's, at low levels of the minimum wage, which arguably the US has, a higher minimum wage is not that harmful. And so, economists don't, when they're working for an administration, they don't resist it very much because it's not that harmful at low levels. But in principle, what a minimum wage does is it's helping people who are one rung up on the economic ladder at the expense of people at the very bottom, people who are, for example, disabled or who have a low IQ and therefore have trouble doing jobs. I mean, they need jobs that have very low wages. So better to get their wages up by the government paying part of it, or better to get the wage plus wage matching up and have them be able to get a job because it doesn't cost much for the employer. I think it's very corrosive that people figured out this polemic of saying, oh, it's terrible that the government is subsidizing employers this way. No, it's good for the government to be giving money to encourage people to work that's not making it too expensive for companies to be willing to hire them. I mean, we want to encourage philanthropy too, but let's not mix these things up. To some extent, business should be business and philanthropy should be philanthropy. It's don't try to act like businesses are doing a terrible thing if they're not doing what your philanthropy should do.
So,
businesses,
we
want
might
to
be
align their incentives with society, but part of aligning their incentives with society is to encourage them to hire people whose marginal product is low. You want those people to be hired. You want them to have a decent amount to live on, but it doesn't have to all come from the company. Some of it can come from the government, encouraging them to work.
But so when we speak of let's just say basic income, or even the idea of being able to afford things, and more so from a global perspective, and since we are in the realm of most transactions being electronic and not necessarily physical, what is your idea of, let's say, a universal currency? And let me tell you where I'm coming from. When we speak of today concepts like purchasing power parity, it's not just X amount of money is able to buy Y amount of consumables or commodities. It's also the fact that X amount of effort in one country gives access to Y amount of commodities, maybe, yeah. But same in a different country gives access to less or more commodities, which to a fair degree seems unfair. So how would you tackle that with, let's say, the idea of a universal currency? And if so, what should be the traits of this universal currency?
Well, I mean, a lot of this is really just about countries at different stages of economic development. And so it's kind of normal to have a lot of services and non-tradables be relatively cheap when a country is poorer overall. And I don't think that has a lot to do with the currencies. I mean, you can't, there's a lot of long-term real forces that determine the real exchange rate between countries. And I think if it's not done by currency, it would have to be done by price changes, which could be painful. So to me, when you think about different currencies, the key thing to know is basically you get one monetary policy per currency. Now, like, so there are countries that just use the US dollar and they're stuck with US monetary policy, whether or not US monetary policy is appropriate for them. Now, they've chosen, the countries that have dollarized have done that because guess what? US monetary policy is better than the monetary policy they would have had otherwise. So if a central bank or otherwise a country has done bad enough monetary policy for long enough, they say, okay, importing US monetary policy is better than what we had, but then it's not perfect. And I think the euro was a huge mistake done as it is, because it forces it means that Germany and Italy have the same monetary policy. Well, Italy needs different monetary policy than Germany. Now, I mean, there were I mean, it's not like there were some positive aspects of certainly of the European Union, huge number of positive aspects there. I'm not sure I totally know the history, but to the extent that countries were told you've got to clean up your act before you can join the Eurozone and use the euro as a currency. It could well be that being forced to clean up their act was a bigger plus than the downside of the euro making them share monetary policy with a lot of other countries. But the having to share monetary policy with a lot of other countries is a big problem. So it doesn't, it's a case-by-case thing whether joining the Eurozone made sense or not. And it depends on how beneficial that cleaning up the act that they were forced to do was, and how bad their monetary policy would have been otherwise.
So to an extent, I can agree that, different countries might need different policies, monetary policies, depending on what stage of development they are at. And it's not like a one size.
Well, not by stages of development, more in terms of different shocks they face. So Italy is going to face different shocks than Germany. And so they need a different monetary policy. And so you can have two countries that are at the same level of development who still need different monetary policies.
Sure, but is it not possible or realistic to have, let's say, different monetary policies for different geographical borders, but they all deal with the same currency?
No, pretty much you have only one monetary policy per currency. So there's not, my leaning is to try to do as much as possible with monetary policy, and that you can, at the national level, you can close the gap between aggregate demand and aggregate supply by monetary policy. And you want to do that as quickly as possible. And I think, what are the remaining roles for countercyclical fiscal policy? Obviously, long-run tax policy matters for the reasons we said. That's different. Short-run fiscal policy, well, monetary policy has some lag, so it might well be that I've proposed as a countercyclical tool that you have national lines of credit. So the government basically provides a line of credit for each of the individuals, or better yet, the government has required saving by everybody in the good times, and then they release that money in the bad times. And we actually have a little bit of this now with how retirement savings accounts are treated in a bad recession. They'll change the rules so you're penalized less if you take the money out. But I think that could be regularized more and made more powerful. So I think that's better than tax rebates. So I've argued that this is more fiscally efficient, because if you're just loaning people money, it doesn't cost a lot. Or if you're letting people have access to their own required saving, that also clearly has no fiscal cost. Then there is a role for fiscal policy to get aggregate demand right for the countries within the Eurozone or for individual U.S. states. And I think that's another area where this, I think the best way to do countercyclical fiscal policy is things like these lines of credit or required savings. So you could have the state do some required saving. It goes into a fund for each individual. They can tap it during the recession. That could be a very nice fiscal policy at the state level. And in the U.S. state level, you can't do monetary policy. And in the country within Eurozone, you can't do monetary policy. So I think there is a role for fiscal policy in helping get aggregate demand right in the different regions within a monetary policy zone.
Got it. So let's say when we're dealing with multiple parallel currencies, for a long while, the value of money was represented by, let's say, gold reserves or other natural resources. And off late, maybe it's represented by the amount of debt that it allows to be created and lended. So from a more fundamental perspective, when we speak of multiple currencies, do you sort of look at any variables that include, let's say, effort in sort of defining the SI unit of money? like how we have an SI unit of time or distance, how do you look at, let's say, SI unit of money?
Oh, well, that's essentially in the system I'm recommending, and in terms of things we've already talked about, that's the job of the central bank. So the job of the central bank is, in the short run, do macroeconomic stabilization to have aggregate demand at the level of aggregate supply. So to be at the natural level of output. In the long run, and then the central bank has a long run job too. And the long run job of monetary policy is to try to have a good unit of account. The most crucial role, that is the most crucial role of a central bank. But it's really the unit of account function of money that's most central to both of these. I mean, it's really the interaction of the unit of account and being able to set an interest rate in that unit of account with sticky prices, or the moral equivalent of sticky prices, that's giving central banks their short run power. And in the long run, you want it to be a good unit of account. You want to have zero inflation to make it a good unit of account in the long run. So it's it looks the same at different points in time to the extent possible. And we want to have inflation so low that there are big debates among economists about what price index do we define zero inflation in terms of. We want to have those debates because we have inflation so low. And I mean, this is kind of a minor. I mean, this may not be a huge thing, but we're in at least a small way, we're cut off from an understanding of the past by inflation. So I had a colleague at the University of Michigan who taught a class about economics in Jane Austen. So one of the things she would teach about is how much money was that they were talking, in modern terms, how much money was that they were talking about in that scene in Jane Austen. And it takes special expertise, as it is, to know things like that. And so that's just one of the many ways in which inflation confuses people. Now, I should say, so zero inflation is a big deal, and zero inflation in what price index, that's part of this decision of how do you make it the best possible unit of account over time. And you can depart from that in the short run, because this countercyclical thing, I think, is more important in the short run. But in the long run, the zero inflation, and I do have to say, in terms of zero inflation, there's one big issue we haven't discussed yet, which is downwardly sticky nominal wages. And so this is a serious objection to zero inflation, but I think it can be dealt with. So Ruchir Agarwal and I talk about this in our papers. There's a wonderful book by Martin Weitzman called The Share Economy. So he's one of the three very prominent economists who's fallen fairly recently to suicide, which is very sad. But which ties into some of the earlier things we've talked about, getting our mental health in line is really valuable. So the way you can deal with this issue is the idea of the share economy is to have to have a substantial component of compensation that's kind of contingent, that is higher when the company is doing well and lower when the country is doing badly. So Japan actually has a lot of this. It has large annual bonuses. And so Japan has had a lot of problems because of the zero lower bound. But interestingly enough, I don't think they've had huge problems from downwardly sticky nominal wages, because they have this bonus system. So they had the requisite flexibility. So the solution to downwardly sticky nominal wages, to me, is make them less sticky by, you can use the tax system, as Martin Weitzman talks about, to encourage having more paid as bonuses or some other form that kind of goes up and down with the firm's fortunes, and can be at any rate can be cut in the recession without people, hopefully structured psychologically in a way so that people don't get too offended. And the bonus is that kind of thing. It's pretty well structured psychologically. It's not guaranteed, more in good years than in bad years. And you've made wages less downwardly sticky, and you've taken care of that problem. So that plus a robust negative interest rate policy, and we get to have zero inflation.
Interesting. So maybe just a couple of questions for which you might want to give very short answers. Just sort of trying to get an idea, right? What would you do if you had $1 billion in your account today?
Oh, that's easy. I've thought about this. So I and I don't need the $1 billion myself. I have this fantasy of being made, having some billionaire make me the executive director of their philanthropic fund. And so what I would do is exactly what I was mentioning earlier. Is I think that $1 billion of philanthropic money could easily be turned into a $1 trillion or much more of social welfare by doing research on diet and health. And this is relatively expensive stuff. You need $10 million for each randomized controlled trial. So $1 billion gets you 100 randomized controlled trials, or 50 randomized controlled trials, plus a lot of other stuff. And we could really prove what's good in terms of diet and health, and convince people. And that's worth an enormous amount. And I think there are other things that can be done, but this is a big one. Gary Taubes, that I mentioned before, who's where I recommended the case for keto. He's been doing this some. I don't think to the tune of $1 billion, but if I had $1 billion, I'd say it would be cool to be involved in that. Short of that, I really want to encourage economists to get involved with studying diet and health. I think economists shouldn't be in some economic ghetto. We should be studying everything that we have a comparative advantage for studying. And economists would be good at this, because first of all, if you think of epidemiology, that has all the same statistical problems that economists are trained well to deal with. Economists can read the literature. These are short papers. They're pretty clear about the statistics. They have some technical words in them, but you can easily get up to speed on that. One way to get up to speed on a lot of the technical things is just to listen to Peter Attia's podcast. So I think even without $1 billion in hand, I think economists can do a huge amount of good in the world by getting involved in research in diet and health. I mean, economists should be getting into the substance of production functions for obesity, for example, and not just the money sides of things. And economists should be getting into also the production function for learning. And when they study education, not just be about the money side of education, but also be about the production function for learning. But anyway, personally, if I had $1 billion, that's what I'd do, is I'd study diet and health. And I think I could find the right people to team up with. So it's not like I need to know everything to do it myself. You could hire people and team up with people. But I think there's a huge philanthropic opportunity there for somebody who is also gets excited by learning new science.
Interesting. And if you were to build a fintech today, what would you build?
If I were doing a fintech startup,
yeah,
Well, this again is about what raises social welfare, but I think the fintech that can bypass credit card fees is what I think is exciting, and I really kind of outlined that before. You've got to have something where somebody. I think of the example of PDFs, what Adobe did there, right? Adobe, I would, there was a point in my life when people started mailing me PDF files. And then they said, oh yeah. And then it's like, you worry, oh, can I read this? And it's like, oh, you just go click on this link. If you can't read this, click on this link and download the program to read the PDF file. Well, I think for fintech payments, getting the economy to avoid credit card fees is what's exciting. Now, unfortunately, fintech folks in the payment sphere mainly have wanted to just get their cut of those credit card fees. And that's not doing a wonderful thing for society. Eliminating most of the credit card fees, that's what would be a good turn for society.
But how would you eliminate the credit card fees?
You just make a slick payment system. Like I say, I want the central bank to provide the payments backbone, ideally. And so lobbying for that might be part of the story. But you need to have people be able to arrive at the store. The store says, okay, you can, let's say they say you can either pay cash or you can pay through this electronic app. And then you need people to be able to sign up on the spot. And so again, government help to make that kind of thing possible would be useful. But somehow you got to figure out how they can verify their link to their bank account and how they can sign up on the spot so they can sign up in 15 seconds or 30 seconds and then pay at the store and then take their stuff out of the store. So
you think the idea is to reduce the number of participants in the system?
Well, the fintech is kind of replacing the credit card companies, but hopefully this is so competitive that the fees get driven down to close to zero. And that it doesn't cost a lot to do electronically. But you have to. That's what you need. You need instant sign up for your payment system. You need people to be able to show up at the store without the app and walk out of the store having paid for things with the app.
So it's got to have a simple onboarding process.
Exactly. And I think the hard part of that is verifying their bank account. So that, I mean, it's like the electronic equivalent of a debit card. So this is obviously genuine technical challenges, but someone will eventually do it. And it may be that the system evolves. So it may be you get the central bank providing the backbone. It may be that at some point, people will have verified their bank account for some other app already. And so you can sort of tie into that bank account verification that's in another app that they already have on their phone or something. So I do think eventually this will happen. But whoever can solve this first and have basically, I mean, so far, I worry that a lot of fintech has been fairly greedy still. It really just wants its slice of the fee pie. But the real change in the world on payments is when somebody says, I want to minimize the fees and make money off of having everybody use it.
Right.
Because it has very low fees. I mean, that's what's going to be exciting.
Interesting. And one last question, Professor. What gives you the drive to sort of still work every day?
Oh, to still work?
Yeah.
Oh, well. Well, I mean, some of my work, it's like they pay me money. So it's like, it's not like everything I do as a professor is fun. I mean, I have to do certain bureaucratic things that I do because they pay me. But in terms of the research and the blogging, for which I only get paid in a general sense, like I get paid the same, paid based on the idea that I'll do research, but the amount I'd make if I did zero research would only be a little bit less. On that front, that's a great question. I mean, I don't want to instantly default to something that would make me look good, but it's fun, and it's I think for me there's a lot of the answer boils down to why I'm an economist rather than a mathematician. Truth be told, I get to be a mathematician a lot as an economist. But why am I not a math professor? Well, okay, it's nice that I get paid more than a math professor, so that's not inconsequential. But I think the other thing that was big for me, and in fact was more present in my mind than how much I'd get paid, because I thought, oh, I'll make enough. I'd make enough as a math professor. Now, maybe in my young naivete, thinking that, I thought, if I'm a math professor, I'll never be able to explain to other people what I'm working on. And it's really true. I mean, you go look at a math paper, you can't understand.
You're constrained by vocabulary.
The chances are you won't be able to understand the abstract. You won't be able to understand what problem they're working on. And it's like math journalists have to work really hard just to get people to have any inkling what the problem is, with zero inkling of the solution, oftentimes, or only a small inkling. I mean, math is just so advanced. But the other dimension of that is just wanting to have an effect on the world, that sense of efficacy. And the great thing about economics is you can do a lot of math and you can see how you can have an effect on the world. And I think I was a little optimistic about everybody being able to understand the economics I do when I tell them. But if I work hard enough on my blog, enough people understand it that it's fun and rewarding. So that's fun. But being able to have an effect on the world, and I guess, I think I have some amount of altruism, but it's not all altruism. It's that sense of efficacy, which really feels good.
Interesting. Thanks a lot for this candid and deep, elaborate conversation, Professor.